If you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100, cut in half. Okay. That was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up eightfold from price low to bull high. Okay. These are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for, 2 decades almost. Okay. And then in 2001, with a low at around $260, it surged the second time. And when it peaked in 2011, a longer bull market, but the same dimension, eightfold gain in price, bear low to bull high. Okay. And then it topped and you had to drop back to $1,050 in 2015. And if measure that as the bear low that, followed that high, we're only a fourfold move.
Few analysts are prepared for the gold S&P 500 relationship's next phase. Michael Oliver found that gold's performance relative to the S&P is hitting a decade-long resistance line that has dictated the balance between monetary metals and U.S. equities since 2015. This line has been touched by big external shocks, the 2015 market tremor, the 2020 COVID-19 pandemic, and the early 2023 dramatic equity sell-off. The spread is breaking out again today without an evident cause. Oliver believes that is the clearest indicator of a market revaluation. No longer does the S&P define direction. Despite historically high stocks, gold is dominating. A spread under these conditions frequently lasts years. Oliver goes on to a more intriguing development: spreads within monetary metals. Silver tends to outperform gold amid big monetary demand shifts and has increased volatility when gold strengthens relative to the S&P. Oliver believes silver is nearing another turning moment. He says the silver-gold spread has been grinding down to next to free levels for years, which rarely lasts. The price spread and momentum spread have reached structural ceilings. Momentum is approaching the breakout level, and Oliver says momentum usually leads price. The market's subtle indication that silver is ready to lead, he believes. Oliver prioritizes silver and silver-related stocks over gold and gold miners. Gold has reached new highs, and gold miners have surpassed 2011 levels, but silver miners remain undervalued. Lag is not weakness. This structural compression precedes fast catch-up. Oliver believes silver versus gold, SIL versus GDX, and silver versus the broader metals complex are approaching levels that anticipate spectacular upside. Silver will outperform gold in the next bull market era, according to his estimate. Please like, subscribe, and share this video with precious metals enthusiasts before we discuss Oliver's spread framework and why silver may be reaching its most crucial moment in over a decade. Your contribution lets us provide high-level analysis to investors who seek clarity, not noise. Please enjoy the video, and thanks for supporting us.
Look at the gold price chart anytime you want. You punch it up on your screen, see a weekly or monthly, say, my golly, that's huge. It's got to take a profit. Time to get out, et cetera. The gold trend is, there you go. Naturally you want to get out. If you go to my report, I'll show you a different version of this gold chart.
So here we are, Michael. I've got your chart here of the gold monthly ratio scale since 1975 up. Let's go ahead and walk through some of the significant takeaways here.
Well, and compared to an arithmetic chart, which looks like it's gone ballistic, if you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100. Cut in half. Okay. That was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up eightfold from price low to bull high. Okay. These are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for, 2 decades almost. Okay. And then in 2001, with a low at around $260, it surged the second time. And when it peaked in 2011, a longer bull market, but the same dimension, eightfold gain in price, bear low to bull high. Okay. And then it topped and you had to drop back to $1,050 in 2015. And if measure that as the bear low that, followed that high, we're only a fourfold move. Again, that low was 1,050. We're $4,000. Okay. You go to 8,000 plus, and then you could at least say, oh, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000. But anyway, the point being here, quit talking about gold being overdone. Okay. And then there's a more important chart, the one we're really, I'm going to say looks at momentum and structure. But in this case, what we're looking at is simply price versus price, a spread chart. And back in 2013 in particular, gold was collapsing. Peaked in 2011, went sideways 2012, and really started to come apart in 13.
And this is gold. And this is gold divided by the S&P.
Yeah,
so
this is take a front month gold future, divide its price into the S&P, express it as a percent.
Right. So anytime the chart goes down, it's the S&P outperforming gold.
And gold underperforming the S&P in this case. We could have flipped it the other way as well, but in which case you'd have a topping pattern as opposed to a bottoming pattern by gold. But anyway, you can see that since 2015, when gold made its bear low in price, that was when it was just above 50% there. It was right where gold price actually ended the downside. If you go sideways from there for 10 years, you've been either side of that level equally. Meaning, it depends on when you look at it, but gold's been par to the S&P. It's done just as well as the S&P with ebbs and flows, better times, worse times, but sideways. Now, but in that period of 10, 11 years, I count 1, 2, 3, 4 highs that define a gradually declining resistance line. We hit it back in April. That's when gold was surging in net price. That's when we hit it the last time there. That's April of this year. No, the other time. There they go. That's when gold was surging in price when the S&P was dropping 20%. That's not supposed to happen according to common wisdom. When the S&P gets kicked bad, gold should go down too, right? It's falsehood. Anyway, you did back off from there, and gold went sideways in price for 5 months. It hit 3,500 and just went dead. Constant selling, but no real sustainable downside gains for the bears. Now you're intra-month with a week to go in the month. You're at 61%. You close a month at 60% or higher, dividing December gold future into S&P. And that's a breakout. So what this chart is telling you is if this were a price chart and the average guy looked at it and say, oh boy, this is a major breakout, I got to buy this thing. Well, that's right. It's telling you that gold is, while it's been doing okay versus the S&P for a decade in real terms, up and down, but sideways, it's breaking out. This is just starting. This isn't some old game. It's just starting. That's a fresh breakout. Again, if this were a price chart and you saw that happening, you wouldn't say something's about the end. You'd say something's beginning. Okay. So what this is telling us is there's a major asset class shift out of especially the U.S. stock market bubble, which is probably the biggest one in the world. Many other markets don't have bubbles like we do. They're up like us, but not bubbles. And into monetary metals. We've already seen evidence of that. The last couple of years, gold's been doing well versus S&P, but it's only begun. We've just broken out of the massive base. So when this breaks out, it's likely to happen this month. All you do is hang around on the spread and it breaks out. This thing's going up for years. You don't have a base like this that go up for 2 months and then fail. This is a start of something. So it's an investment grade smack in the face. Reality's changing, guys. Something's going on.
Silver's structure differs from gold's. Oliver sees such huge upside potential because of that disparity. Gold has confirmed a huge structural breakout relative to the S&P, whereas silver has spent several years in a staircase fall, despite holding its own in absolute terms. This divergence created a very tight, compressed spread. This compression rarely resolves gradually. Historically, silver tends not stabilize at low spreads. Reaffirms itself. Current readings hanging just over 2020 spike levels put silver back at the brink of a trend line that has defined its underperformance cycle since 2021. Breaking the horizontal ceiling at 1.32% on the silver versus gold spread would end a 3-year structure.
Okay. That resistance wasn't, you didn't come back a second time and get back above the first peak. Each time you hit it, you didn't get back above the peak that hit it. You started down. And either that meant gold was going down in price or gold was going sideways. Like from that 2020 high, collapse in the spread was big. Gold also went down, went down 20% in price from over 2,000 to just above 1,600. But it also dropped a lot versus the S&P was firming then. Okay. In fact, S&P was making a high and NASDAQ 100 was making a price high in late 2021 when that spread was below 40%. That lowest reading you see there. That was a coincidence, but gold go down and stock market making a peak, price peak. Anyway, since then, you pulled up, built a base, a little mini base there, and you broke out of that back in March of this year, earlier this year, and then surged up to the April high. But this time, instead of falling down away from it and continuing down, you're back above it. It's a statement of intent. Okay. Anyway, this is a table pounder, and this is the kind of thing that if you're thinking of investing long term, it's saying you need to reorient your thought process. Something's going on here. Formative chart. It's effectively hit what it's saying is zero. Okay, I'm not going any lower. Okay, this is a spread chart here versus silver versus gold, the top chart.
Okay.
Top chart's a spread chart. And it's week to week instead of month to month. And we go back to 2020. And back then, that's when silver and gold both surged into late 2020. And gold went up 40%, but silver doubled. Okay, so this spread went, ooh, wow, an explosive move in a handful of like 6, 7, 8 months, okay, in terms of percent gain in price and percent gain on the relative basis. But then in late 2020 and early 2021, the spread peaked at 1.5% thereabouts and dropped. Now, silver also, like the miners back then, while gold went into a range for a couple of years, sideways range, up and down. Silver and the miners went into a more or less staircase decline. And it particularly shows on the spread chart. So while gold was sort of going lateral, they were sort of going staircase down. So the spread deteriorated. Now, during that time, silver was going up in net price. I mean, you can go back to, 2022, there was a low there at 1.05%. But, the spread's above there now, going up in price at the same time.
Right.
But it's still underperforming. Now, recently, you'll notice since March, April of this year, which is when gold stalled, remember, at 3,500, the spread has exploded from what are historically very low levels for that spread. Getting under 1% is like, it ain't going free, okay? Right. You're buying something that's next to free. So silver shot up, and it's now, this is last week's close, marginally above a downtrend going back to 2021. But the better line in our assessment is that green line, the horizontal. Mm-hmm. And that line gets taken out. We're dividing D silver into D gold and expressing it as a percent. That's how you come up with this number. 1.32%. You ever see a weekly close of December silver versus D gold that puts the spread at 1.32, blows out that ceiling that goes back to 2022. 3-year ceiling, perfectly horizontal, very clear. Okay, but already it's taken out a trend line. Now, if you'll scroll to the chart below, it's momentum of that spread. Okay. What we do is we take those spread readings you saw above and plot them in their relationship to a 40-week moving average of the spread. Okay, mm-hmm. 40-week average is almost like a 200-day line or a 3-quarter average. So is the spread above that average or below it? And you oscillate it accordingly. And notice that it's created the same horizontal structure. Mm. The only difference is we're at it. Momentum almost always leads price.
So So
Spread.
just so I'm reading this chart correctly, and for the sake of the audience, this is telling us that we are right at the 40-week moving average.
No, the 40-week is the zero line. The level that's important there is about
Okay.
it's about 0.14. You can see the scale on the left. Okay, so if silver spread closes 0.14% above the 40-week average, which is the zero line, it will blow that ceiling. And we hit it about 3 months ago, backed off, and right now we're pressing at it again. Now, you close a week out on the spread chart at the top, about 1.26%. It's going to cause this spread momentum chart to break out. Almost always when you have a momentum breakout, the spread will follow. Or if this were momentum of price, then price would follow. So we're focused also on the momentum of the spread, because when it breaks out, that gives us a heads up. Expect the spread chart itself. Now, what does this mean? It means as gold enters a massive asset shift favoring itself versus stock market, within the monetary metals, silver's about to shift into a leadership position. So yeah, gold thumbs up, but silver 2 thumbs up, because it's going to beat gold. So if you're focused on monetary metals or miners, my personal emphasis is on silver and silver related, as opposed to gold and gold related.
Oliver sees a multi-year realignment in the precious metals market across all indices. Gold's breakout versus the S&P is the market's first major acknowledgement that monetary assets are cheap relative to U.S. equities. The absence of an external crisis during this breakout makes it crucial. Gold has previously outperformed only after big shocks or forced capital rotation. It outperforms the S&P, which is near record highs. That shows early strategic repositioning, not panic, drove the capital shift. Such influx underpins long-term bull markets. Gold has excellent long-term prospects. Oliver argues that the bull market is structurally early, regardless of gold's price. The current consolidation above $4,000 is normal, not a top. When the gold versus S&P spread breaks out on a monthly close, it will likely herald several years of asset allocation moves away from stretched equities and into monetary metals. If markets struggle below the surface and geopolitical concerns remain unresolved, gold's stabilizing role becomes even more important. Silver is expected to lead this cycle. Its spreads, momentum structures, and miner relationships indicate a poised asset for leadership. The market may soon shift in favor of silver and silver miners, according to Oliver's research, as the compression unwinds. This is a key precious metals market indicator for investors who focus on structural setups rather than short-term noise. If you find this analysis helpful, please like, subscribe, and share it with gold and silver market followers. Your assistance spreads detailed, data-driven analysis. Thanks for watching, and stay tuned for the next deep dive into this metal cycle's forces.